Welcome to the Gamma Brief. I'm your host, Alex. If you're new here, the Gamma Brief is an experiment. I'm using a layered generative AI pipeline to reliably capture market data, economic events, and structural mechanics, and then turn all of that into accurate, actionable briefings every morning, every evening, and every weekend. If you've got ideas on how to make this better, things that you want to see, things that are not landing, drop them in the comments. Constructive feedback is fuel for this experiment. As always, this is market intelligence and not financial advice. All right, let's get into it. Thursday, March 12th, 2026, 7:30 a.m. Eastern. ES futures are trading at 67.52. Yesterday's regime contradiction, where positive gamma behavior masked negative gamma structure, is officially over. Today, the structural fragility is exposed. If early economic data surprises, then expect amplified trend-following momentum to take control. We are operating in a negative gamma regime this morning with the VIX elevated to 25.14. Dealers are net short options. In this environment, market makers are forced to buy into rallies and sell into dips to hedge their exposure, a mechanical flow that actively amplifies intraday volatility and creates trending, momentum-driven sessions. With a 70% probability of a high volatility day, this tape is unanchored. Looking at the critical pivots, the options-derived dealer gamma resistance sits at the 7,000 call wall. Downside gamma support is concentrated at the 6,700 put wall. We have a massive expected move today of plus or minus 107 points. If we breach 6,700, dealers will accelerate selling to flatten their delta hedges, opening a significant trapdoor. Overnight, markets were dictated by geopolitical tension in the Strait of Hormuz. Crude oil brushed the $100 per barrel mark, which is lifting treasury yields and pressuring equity futures lower. The overnight gap reflects persistent risk premium as traders price an external energy shock against domestic economic resilience. Today's risk radar sits at 4 out of 5. At 8:30 a.m. Eastern, we get a heavy data drop, including initial jobless claims and the January trade balance. At 11 a.m., Fed Governor Bowman speaks, followed by the Atlanta Fed GDP Now update and a 30-year bond auction at 1 p.m. The asymmetric risk today lies in the 8:30 a.m. print. A hot labor or inflation proxy will spike yields further and trigger dealer selling, while a cool print could spark a rapid short covering rally that dealers will be forced to chase. Strategically, this is a convexity and long gamma environment. Selling iron condors or trying to collect premium here is playing with fire. The lack of stabilizing dealer flows makes mean reversion highly vulnerable. Stick to defined risk directional structures like debit spreads that benefit from volatility expansion and trend continuation. The bottom line, we are in a high volatility, negative gamma regime where breakouts will see follow through. The 8:30 a.m. data stack is your primary trigger for the session's directional bias. The regime is primed for a flush. One bad print and the trapdoor opens. Levels set, bias defined. Good luck out there. If you want to see more of the Gamma Brief in your daily rotation, hit that subscribe button and don't forget to like. Standard disclaimer applies. This is market intelligence, not financial advice. Derivatives are high risk. Always trade your own plan.